Hello, this is Richard with SoCal Warehouse, and in this video, I'm going to walk you through step by step how you can value your commercial real estate property like a pro. It's important to know first, before you start considering valuing your property, that there are two ways that commercial real estate is valued. First and foremost is going to be the comparable approach. And this is the easier approach that you can go about, and it's really similar to how residential properties are valued. What are comparable properties like yours that have recently sold, traded in your market at a price per square foot? So if you have a 5,000 square foot warehouse, we're looking at other warehouse comparable in vintage of the year it was built, comparable similarities as far as property characteristics, height clearance that have recently sold at a price per square foot basis. So that's the more general route to go. I prefer the second way to value your property, and this is what I'm going to walk you through in this video today, which is the income approach. And these are how lenders look at commercial real estate. These are how appraisers look at commercial real estate as a value is concerned. And it's a simple formula that we're going to go over today. Okay, the formula goes value to determine value. It's the net operating income divided by the market cap rate. Okay. So there's certain variables that we have here. First and foremost is the net operating income. And to calculate for the net operating income, that's another formula that we're gonna go right here below. And it's simple. It's the net operating income equals the gross revenue that property is collecting minus the expenses that property currently has, that you have as the landlord of that property, okay? So here's an example of how we're calculating the NOI. Okay, let's say that your property's grossing $120,000 per year, okay? And your total expenses are $20,000. I want to give you an example of some expenses that you may have on your property that you need to account for. First would be taxes. Another would be insurance, utilities, maintenance, repairs. Any expense that comes out of your pocket as the owner of the property needs to be accounted for when you're calculating for the net operating income, okay? You may have heard of what's called a triple net lease, where the tenant actually pays for all of the expenses. And in this case, your total revenue would be your net operating income. But unless you have a true triple net lease, you're more than likely going to have some type of expenses. In most cases, the most common are taxes and insurance. That needs to be accounted for when you're going to calculate the value of your property, because that's what's going to give us the net operating income, which is right here in the example that we just went over. 120,000 gross minus the $20,000 is $100,000. Okay, $100,000 of net operating income. Okay, so back to the formula of value. So we just solve for this. We got the NOI. The net operating income is down here, $100,000, and we need to divide that by the market cap rate. There's a lot of confusion around cap rates. In simplest way to explain it is that it is a snapshot of what is going on in that market, in your market, based on the property type that you have in your geographic location. Okay, so different asset types, office, industrial warehouses, retail, multifamily apartments, they all have different cap rates in your market. So it's important to know the cap rate. It's important to have a broker, have some counsel that could advise you on what the going cap rate is based on the vintage of your property and the property characteristics of your property, because you cannot compare a 1950s warehouse to a 2020 warehouse. Those are going to have different cap rates. But it's important to know this, but we need a cap rate in order for the value to be calculated. Okay, in our market right now, a pretty sustainable cap rate to determine values really across the board on most asset types is 6%. Okay, generally multifamily is going to have the lowest cap rate, and there is a correlation between how low the cap rate is and the value. So the lower the cap rate, the higher the value, and vice versa. The higher the cap rate, the lower the value. And we'll run an example of how the cap rates really do fluctuate the price. Okay, so back to our example here. On $100,000 that we calculated is the net operating income divided by the market cap rate, which is 6%. That's going to give us a value of $1,666,666. Okay, so there's the value right here, and we just calculated that based on the gross income and the operating expenses that you, an owner, would have, and that's how we determine the value. One thing to determine, one thing that I really want to emphasize in this video, if you could find a way to increase your net operating income or decrease your overall expenses here, well, you just found a way to increase the value of your property. And I'll run an example. Let's say that this was on a triple net lease, right? And you didn't have this $20,000 expense, and this was your net operating income. So $120,000, that's a $20,000 difference, okay? Based on the $100,000. So if we ran the numbers on $120,000 net operating income and divided that by the exact same cap rate, the 6%, the market, that would give us a value of $2 million. So from 1.66 to $2 million. I mean, that's $333,000 difference based on $20,000 on your net operating income. And I want to emphasize, this is the power of commercial real estate. You could literally increase your net worth, the value of your property, by just being able to optimize and operate your property at a higher capacity. Okay, so you could do that by decreasing expenses and also increasing your revenues. Okay, and that's what's important, to have brokers involved, a good broker that knows the market, so that they can inform you on what the market lease rates are and what expenses you could pass through to your tenants. Okay, one thing to notice is the cap rate is given, so it is market determined right now. But as soon as the market drops in cap rates, well, your properties are automatically increasing in value. So that's one thing to definitely consider when you're calculating your property. This formula is really good to know while you're considering a refinance, so that you have an idea of what the property is worth and what type of LTV you could get on that property. I highly encourage that you just practice this on your free time. Just, have fun, maybe go through your property portfolio and see what values are at and how you can anticipate your value to increase or decrease based on your current rents and where you project them to go to. As always, we're here to serve. We are a commercial real estate company here, SoCal Warehouse. My name is Richard. If you want to reach out and get a proper valuation of your property or consult on maybe the lease rates, do not hesitate to reach out. We're here to serve. You can reach us at info@socalwarehouse.com. Once again, you can email us at info@socalwarehouse.com, or you can just comment below wherever you're watching this video, and we'll be in touch with you very soon.